All right, guys, so let's quickly take a look then at the week ahead. Just as a quick side note, I do apologize for any potential coughs or sniffs that you might get from my side. I am struggling with a little bit of flu at this stage, so just bear with me on that front. Now, in terms of what's happening this week, before we get into the data, as well as central bank speakers, there's a couple of idiosyncratic drivers we just quickly need to look at. The first one, obviously, is still the ongoing earnings season in the mix. Now, we don't have huge names reporting this week, unlike the massive big tech, of course, that we had a couple of weeks ago. But we do have a couple of names that I think the markets will put some additional focus on. You know, the likes of Home Depot jumps out, the likes of Walmart jumps out as well, especially with regards to the question marks about the labor market, the question marks about the overall health of the consumer, the real health of the consumer. So those names will be in focus. And of course, if we just take a look at the weightings, as always, we can see Home Depot coming up tomorrow, of course, has an almost 6 or 7% weighting in the Dow. So it really does matter, not just from a consumer point of view, but also does matter from a weightings point of view for the Dow. Remember, the Dow, unlike the S&P and the Nasdaq, the Dow is price weighted, where the other two is market cap weighted. So it's not the market cap that matters in terms of the influence that a name has on the Dow. It's all about the share price. So very important to keep that on the radar for tomorrow, Home Depot, and then obviously a little bit later in the week, there will be focus, I think, on Walmart as well. Now, apart from that, we've got a couple of central bank speakers scattered throughout this week, and I think we need to be prepared both for the scheduled ones as well as the potential unscheduled ones, especially for the US. I mean, if we consider the fact that the markets are still pricing in what I would consider is way too aggressive cuts for the Fed. I mean, 100 basis points implied cuts still for the Fed by year end seems a little bit too aggressive. So if the markets are taking a little bit longer than what the Fed will feel comfortable with in terms of expecting these aggressive types of cuts, then we might see more of them come on the scene in a week like this, just trying to ease back those expectations a little bit. Like I said, we do have a couple of speakers out, but I think we need to be prepared not just for the scheduled speakers, but also the occasional unscheduled speakers coming out from the US side as well. Now, the other thing that I thought was quite interesting this week is we obviously have the RBNZ, and we'll touch on that in a second, but take a look at how often Governor Orr is scheduled to talk this week. I mean, we have him talking, let's talk BST or UK time. We have him talking 7 p.m. tomorrow. That'll be on Wednesday. Then at 8:30. Then he's talking at 12:10 as well. And I believe we've got him coming up on, we've got him coming up on Friday as well, which I'm currently of the opinion that the bank will stick to leaving rates unchanged. But when I see this amount of interviews scheduled for him, it does make me wonder what type of decision we're going to get. You know, maybe those money markets calling for a cut, maybe they've got something going here, because it does seem like it seems like a little bit of he's overdoing it in terms of speeches this week, right? So it might be because he knows he's got a lot to say, or maybe the markets will have a lot of questions, maybe. It just feels like a lot of scheduled speeches coming up from Governor Orr, which might make, the decision this week a lot more interesting. It will be an interesting one anyway. We'll touch on it in a second, but I thought that was just important to take note of. We've got him coming up a lot this week, which does seem a little bit suspicious. Now, in terms of the actual data then, let's start with tomorrow, because today is just an absolute snooze fest. Tomorrow, the week kicks off. Tomorrow's got a busy day. We've got UK jobs data coming up, and then, of course, we've got US PPI coming up a little bit later in the session. Let's start with UK jobs. When it comes to UK jobs, remember, there isn't going to be much focus on the actual jobs number and the unemployment rate, because the markets and the Bank of England, they can't trust the data coming out of the employment and the unemployment rate figures, right? The reason for that is the methodology changes we had from the ONS, and the ONS themselves told us a couple of weeks ago, hey, we probably can't trust this data until at least the fourth quarter, looking towards November-ish. So until we get more clarity on when the data can be trusted, the Bank of England will take it with a massive pinch of salt, which means the market will take it with a massive pinch of salt. And that means all of the focus will be on wages. Now, when it comes to wages, wages, looking at this chart, has been stuck alongside services CPI. So on top here, we've got We've got 3-month average pay coming in at 5.7. We've obviously got ex bonus pay coming in at 5.7, and we've got services CPI coming in at 5.7. So as wages has remained sticky, services inflation has remained sticky as well. And this clearly mattered to the Bank of England in their previous decision, right? We heard what the likes of Chief Economist Pearl thought of this. We heard what the likes of Mann, she just early in the session, she spoke about wages again, you know, saying that this the reluctance of wages to be pulled lower obviously risks higher services inflation, not just for the euro now, but potentially structurally going forward as well. So it's something that really matters for the bank. The bank obviously delivered what we can call, for the lack of a better term, a pretty hawkish cut with their prior decision. The markets right now, in my opinion, the markets right now seems a little bit too hawkishly priced going into that September meeting for the Bank of England. I mean, there's only a 41% chance of a cut. Let's just say, give or take 40% probability for a cut, 60% probability for a hold. I think that's a little bit too hawkishly skewed right now, and you know, something that could cure the markets pretty quick in terms of this. I would call it an unhealthy skew in expectation. Something that could cure this pretty quick is just a huge downside surprise for wages and CPI this week. The markets have been so used to both CPI and UK wages staying up there and staying super sticky. I don't think this is a market that is really, you know, we are obviously expecting quite a big slowdown. You know, if you take a look at the 3-month, markets are expecting the 3-month Eurovia to come in at 4.6, which is more than a percentage drop from the prior. So we are expecting a big drop, but with, you know, this chart looking like this, there is obviously a risk that it catches the market still by surprise, even if we get one. So if you consider that, you know, from a positioning point of view, the fact that sterling is still pretty bullish here on the positioning side, especially considering that we had a big reduction. I mean, a massive reduction in pound longs. So a huge move lower in the index level. Despite all of that downside, positioning is still registering a pretty stretched long positioning. So I think my preference for this week, looking at UK data, that includes the CPI and the growth data as well, I would prefer to see downside surprises that just shakes up this 40-60 skew, maybe towards the other end. I mean, if we see wages coming in lower than expected, CPI coming in lower than expected, and then potentially growth coming in lower than expected, I think those three things together should be able to seal the deal for another very close to fully priced cut in September, if we get that type of outcome. If we don't and the data surprises higher, I'm just not sure whether I would be interested to want to chase sterling higher on that. You know, not looking at how stretched positioning still is, despite the big move we had lower in the currency last week, you know, obviously with all of that risk of sentiment that we had. So it just makes it for a tricky one to trade on the long side. I would prefer to trade it on the short side if we get a nice big miss in that wage data. And again, you know, wage data right now, we know it matters in terms of its, you know, close correlation we've seen with services inflation. So if we do get a massive dropout in that, that should give the markets confidence that maybe services inflation is we finally cracked you know, services inflation, if that should happen. So that could be a real negative factor or driver to focus on for sterling. Then in terms of later in the session, we get US PPI. Now, US PPI is going to be a lot more interesting than usual this time around. We had this, I think, the 2 or 3 prints ago as well, where unlike any other times we get PPI, this month, we actually get PPI coming out ahead of the CPI data. Normally we get it the other way around, right? Normally we have CPI coming out first and then we have PPI coming in afterwards, which means in a week like this, there is going to be more focus on tomorrow's PPI compared to months where it comes out after CPI. Now, what's important here to understand is that PPI doesn't usually offer a worthwhile signal for CPI, to be honest. You know, it can be a reason why markets might dismiss or discount the data. And in very recent prints, we've actually seen the markets have a tendency to, instead of getting one directional or one-sided directional flows out of the PPI, we've actually seen the markets have a tendency to fade whatever type of move we get out of the initial PPI data. So it makes it a little bit tricky to trade. However, given that PPI does come in ahead of CPI, if we were to get a really clean and very clear deviation across all 4 the PPI measures, that could potentially be something that we might consider trading into something like CPI. I'm talking about a clean and clear miss across the board, right? Talking about all 4 measures coming in much lower than expected, or all 4 measures coming in much higher than expected. That might give markets more reasons to potentially want to trade PPI into CPI the next day. But personally, I'm probably gonna want to stay patient on that PPI. It just hasn't provided good enough opportunities in the last couple of prints, which makes me a little bit hesitant on wanting to trade it, Doesn't mean it can't be a big move. The markets will be focused on it, of course. I'm just a little bit hesitant based on the recent reactions that we've seen out of that PPI. It's been a better fade trade than a trade. So that is something definitely just worth keeping in mind going into tomorrow's PPI. Then in terms of Wednesday, we have the day starting out with the RBNZ policy decision. That's going to be interesting. And then we've got 2 major batches of data on the inflation side coming out. Obviously, UK CPI followed by US CPI. Now, let's talk about the RBNZ first. I think the RBNZ decision is going to be a really interesting one. There are 2 things that the markets will be watching very closely for the RBNZ. The first one is whether they cut rates or not. The reason why that is so interesting this time around is because the markets are so divided. The markets they have no clue what's going to happen. Rates markets prices a 75% probability for a cut. In my opinion, that's pretty high based on the recent data that we've had. Don't get me wrong, June data has been pretty bad. We've had a decent deceleration in survey measures, showing quite a lot of stress or potential stress in the economy. Forward-looking measures of price increase expectancy has dropped considerably as well. But, if you consider, and this is where the second focus will be, if you consider how big of a change it would be for the bank to go from pricing in a first cut the end of next year and bringing that forward by a whole year and then some, it just feels very, very aggressive of a change, right? Think about what this would mean from an optics point of view for this bank. They would have to admit that, hey, remember 3 months ago back in May when we said we're only going to be cutting rates or potentially cutting rates in the 3rd or the 4th quarter of next year? Well, we're going to be bringing that forward by a whole year. That just looks really bad, right? That'll be the bank basically admitting that they are totally useless in terms of forecasting, and they've had to bring that forward by a whole year. I think it makes more sense, even if it's just from an optics point of view. It would make more sense for them to not cut rates and then potentially signal that they're bringing it forward maybe, to the 4th quarter of this year. I just think that makes a lot more sense than them just rushing into cuts. It feels like it would be too much of an admission of failure right from their side. I mean, that would be a really big change for them. It's not impossible, but for me, I'm leaning more towards a hold with that in mind, which makes that 75% very interesting, because that means, and obviously considering the fact that the Kiwi right now is straight short in terms of positioning. If we look at positioning data, the Kiwi is currently straight short. It means that with that straight short positioning in mind, if we were to get the bank holding rates and not cutting rates while money markets are pricing 75% chance of a cut, that would, in my opinion, be by far the best or the most attractive opportunity for the Kiwi this week out of that event, is for them to hold rates, signal it to potentially happen somewhere towards the end of the year, and that providing us with an opportunity to just look for some mean reversion in the Kiwi, right? We've seen a massive amount of downside in the Kiwi dollar. I mean, if we go to the index chart here for a second, the Kiwi has seen a huge amount of deceleration. Like we said, positioning has gone back into stretch territory on the short side as well. So I would prefer upside for this currency on a hold. Look, it's possible that they do cut rates. It's not impossible. And if they do, that could still see some downside for the Kiwi. But Yeah, I'm just not sure how they would need to be really, really, really dovish in their where's that OCR? Here we go. They would need to be really dovish in their OCR projections to get me excited about shorting the Kiwi out of that event. So that's going to be one to watch. And again, you know, on this week's decision, we actually get the updated monetary policy statement, their projection. So it's going to be very important. Two things to watch: whether they cut or not, and how aggressive they see those cuts playing out versus what they saw back in May. Now, apart from that, also on Wednesday, we get UK inflation data. Now, we spoke about this. Like I said, you know, for me, this one, my preference would be to wait for a big miss and trade the pound lower on, given, you know, the market pricing for 40% chance of a cut, 60% chance of a hold. Based on that, based on positioning that is still stretched on the long side, despite the big move lower, I just think the simpler trade for sterling this week is for the data to come in really bad, for the market to start pricing in more cuts, and for us to just look for shorting opportunities on sterling as a result of that. I just think that makes for a much simpler trade, in my opinion. Don't get me wrong, if the data comes in really hot, the pound can obviously still push up, but I don't know whether I have enough conviction to want to trade sterling higher on that. I think the simpler way would just be to look for a miss in the data and then trade sterling lower as a result. Now, the main event, arguably then for this week, will be Wednesday's US CPI data. Now, it's a little bit of a mixed bag in terms of market expectations here. I mean, take a look at this. Core month of a month expected to tick up from 0.1 to 0.2. Core year of year expected to tick down from 3.3 to 3.2. Month of a month expected to go up from negative 0.1 to plus 0.2, and then year over year headline expected to stay flat. So it's a whole mixed bag across the board here. And like I said, you know, PPI can potentially give a change of these expectations. You know, if we do see a massive upside surprise in PPI, maybe the markets are skewed more towards an upside surprise than for CPI. Vice versa, if it's a huge miss, maybe they you know, the whisper number, quote unquote, potentially moves lower than for CPI. There's just a couple of things worth keeping in mind on the PPI front. If you take a look at this chart, let me just quickly go there. Here we go. If you take a look at this chart, PPI has been trending higher for the last couple of, what's it been, 1, 2, 3, 4, 5, about 6, let's just call it 6 months now. 6 months worth of data has shown upside trajectory for the PPI. But CPI has done the exact opposite. It's moving the opposite direction. So, you know, when I look at a chart like this, even if PPI comes in with a big miss or a big beat, that's what I'm saying, or what I said earlier, is I'm reluctant to want to trade PPI on the back of that, because the markets have discounted that largely to focus on CPI, which I do think makes more sense. So, you know, keep this chart in mind when we look at it. Also, you know, July, speaking specifically about CPI, July tends to be a month where CPI has a much higher tendency to surprise lower than any other month of the year. On average, of course. It doesn't mean it's going to happen this month, but it's one of the months where you have a much better skew towards the downside. So even if PPI, for example, comes in higher again, the caveat to that could be that the markets know that it hasn't been a good predictor of where CPI will go, because CPI has gone in the opposite direction, flat or lower, while PPI has just gone up. And obviously, you know, knowing the seasonality of the data, the markets might be able to discount an upside surprise anyway. I think a downside surprise will then arguably be the bigger surprise, the more attractive one to trade potentially. Because if PPI starts moving more in line with CPI, i.e. surprising massively to the downside in a month where seasonality favors more downside surprises in CPI, that will just make for the more, I think that'll make for a more simpler trade to go for, right? It ticks most of the boxes, so to speak. So I think that could be really interesting to look at. In terms of market reaction, it's going to be interesting. I think equity markets will react more counter-cyclical than cyclical to this data, meaning that over the course of last week or the last 2 weeks, equities have traded cyclically to growth and labor data, meaning that good data has been good, bad data has been bad. When it comes to CPI, I think they're going to trade more counter-cyclical again, because if we were to get a massive upside surprise in CPI, with there being growth and labor market concerns, that leaves you with a stagflation environment. So upside in CPI, I think, would be a bad thing for equities right now. And obviously lower CPI will be a good thing. Less drag on growth. It does mean higher potential for cuts, but that won't be because of worse growth and labor expectations. That'll be because inflation is moving faster towards target. So I think the way that we've been trading CPI or equities with CPI, I don't think that changes this week, unlike the way that equities have been trading with growth and labor data. It's very important for us to make that distinction right now. In terms of the US dollar, I think it's going to be simple. We'll just be trading it cyclical. I think it's going to be a cyclical affair, meaning high CPI, I'm expecting upside in the dollar. Lower CPI, expecting downside in the US dollar. I think it's going to be pretty simple on that front. Touch wood, famous last words. All right, so let's quickly take a look then at Thursday. Thursday, we start off nice and early with the Aussie jobs data. Now, Aussie jobs data, it's going to be interesting. Look, whether we get a really big upside surprise or a really big downside surprise, I don't think that's going to change much in terms of market expectations right now. We had the RBNZ, or we had the RBA rather, coming out last week that didn't provide meaningful surprises. They still stuck to a more hawkish leaning attitude, which makes sense based on all of the recent data. So if we get a huge upside or a huge downside surprise, I just don't see that really changing much for the broader policy expectations. But I do think what could be really sexy as a trade in a week like this is, imagine we have the RBNZ coming in more hawkish than what the markets are expecting, right? Imagine they hold rates and they only look for cuts maybe towards the end of the year. That'll go against what the markets are currently pricing in, quite aggressively against that. That would most likely see the Kiwi strengthen and push the Aussie Kiwi lower. And imagine then the day afterwards, we get Aussie jobs data surprising to the downside. I mean, we could see a really decent push to the downside in the Aussie Kiwi in a week like this. And it's normally a good pair to consider from a differential point of view anyway. So Aussie Kiwi could be really interesting, but that's probably one of the only ways that I'll be looking to trade it. Don't get me wrong, if the data comes in really hot, we could potentially look to trade the Aussie higher with something else, maybe against the Swiss franc, which I am expecting to, I'm expecting the SNB to start doing something about the recent strength we've had in the Swiss franc. So maybe Aussie Swiss upside on a beat in the jobs data could be good. But in a week like this, I would probably prefer RBNZ to come in with a hold and then the Aussie jobs data to surprise lower. Just think that's, again, it's going to make for a more simpler trade to look at. Obviously, if it falls in line with those types of outcomes. The other data we get also on Thursday is UK growth data. Now, arguably, this won't be as exciting as the CPI and the wage data will be early in the week, but it will still be watched. I suspect if CPI and wages can fall decently, then an upside surprise in growth won't really matter as much this week. I mean, what I mean is the markets will focus more on wages and focus more on CPI. If those two things comes in bad, then even if growth comes in good, the markets might be able to discount it easier. Obviously, the perfect scenario then would be a fall in wages, followed by a fall in CPI, and then followed by a fall or downside surprise in growth. If all of those three things, like I mentioned earlier, should come in much lower than expected, I think that'll seal the deal for a September cut, at least in terms of market expectations. Whether the Bank of England, follows through with a cut or not, they will do whatever they think is right, and sometimes it's not always what the markets think is the right thing for them to do. But if those three things should surprise lower, I think it should seal the deal from a market's point of view about a potential cut again in September. Now, what we also get later on Thursday is another batch of US claims data. Now, last week, the markets, in my opinion, overreacted to the jobless claims number. Don't get me wrong. It was a really big move, down from 250 all the way down to 233. It eased a lot of concerns about the labor market, but I think the market shows the wrong thing to get excited about because, this data, it's like the markets forgot that jobless claims is super noisy. It's a very, very noisy data point. Meaning that in a week like this, the risk for risk sentiment in a week like this is that we get jobless claims back above 250 this week again. Right? We pushed all the way down to 233. Imagine we go back up to a new cycle high of 262. Then all of the fears is suddenly back on again. And keep in mind, it's not impossible for this thing to do that. We can have it go from 239 down to 223, all the way back up to 245. It happens. It's noisy. So I think there's a lot of risk there for the markets. You know, the risk is that we get a big jolt like this, like the one we had back in the start of the year, which potentially puts us up into that cycle high boundary area. And I mean, that could be really bad for risk. So I do think that's going to be an interesting one to watch this week, especially if we get the data reverse. I think it's the wrong data point for the markets to have gotten excited about last week. In terms of retail sales, I mean, retail sales, you guys know how I feel about retail sales. It's just such a bad US data point, you know. The markets will be watching it, of course, after the labor data, getting a sense of what the consumer is doing. But keep in mind, there's so many caveats to retail sales, just like jobless claims, super noisy. You have the tendency to see huge revisions on the month-over-month basis for retail sales data, because by the time that we get the data, they don't have nearly enough information to really give us accurate numbers. To put it that way. It also only covers goods. It doesn't cover services. So, you know, you miss out on the biggest share of spending when it comes to consumers. So anyway, I'm biased against retail sales as a data point. I just don't like it. But obviously the market will be focused on it. And the preference when it comes to things like jobless claims, fully fed, and retail sales, the best case scenario for a trade out of these things would be for all of them to show us the same thing. Meaning all of them needs to show big deterioration, or all of them needs to show big, appreciation, or moving in the right direction at least. For jobless claims, obviously lower is better and higher is worse, so just keep that in mind. But the bottom line is we want to see better across the board or worse across the board to really give us enough conviction to want to trade something like that. Then moving on to Friday, it's going to be a quiet affair. We've got UK retail sales data coming up, but, you know, it's been such a messy print. We've had huge deviations, mean absolutely zilch for pounds. So it's not going to be something I will be looking to trade. We just haven't had sustainable, predictable volatility coming out of UK retail sales data. One worth watching, but it's not going to be one that I would look to trade. Similar story with University of Michigan. I mean, sentiment will be in focus, and I suspect, depending on what happens throughout the week, that'll depend on how the markets trade University of Michigan data, right? The markets have been really concerned about growth after the NFP print. Some of those concerns have dissipated after the data we had last week. So depending on what happens to claims, what happens to CPI, what happens to retail sales, that will depend how the markets react to University of Michigan sentiment data coming up on Friday. It can be an important one. It can be a market mover, but you know, we'll touch base on that a little bit later in the week as we go through the other data sets that we'll be getting, because like I said, that will influence the way the markets trade this. So that's just a view of the week ahead. It's going to be a pretty busy one. We will have full previews available for all the major events as always, so do make sure to check that out. And as always, any questions, guys, don't hesitate to let me know.